What's up, guys? Crypto Wolf here. How you guys doing? Yesterday, there was a massive sell off in the crypto market. As in, a lot of people didn't expect it. As in, there was just a massive sell off in the market. And many people had their long positions liquidated because they didn't use any kind of stop loss. They were kind of anticipating that BTC will break the 73K resistance and move to the upside. So they were expecting targets such as 80K, 85K to 90K, but it didn't happen like that. You see, yesterday was a gentle reminder that nothing in the market is absolute. There is no kind of analysis that is fail proof. As in, everything that happens in the market, every kind of analysis you do in the market is allegedly. There is nothing that is 100% accurate. A lot of traders forget about this, and it is the main reason why they get destroyed in the market because they fail to have effective risk management principles in place, or because they feel they know what's going to happen next in the market. So this was basically what happened from around this point, and before you know, there was just this massive red candle and this other red candle that just caused a significant losses to a lot of people. Lots of people got liquidated, even in altcoin, because many people are taking altcoin long positions because they felt the altcoin season is about to come in. So they've already taken massive long positions in altcoins and they got liquidated. So yesterday was a gentle reminder that technical analysis wouldn't do you much good in the crypto market because many people didn't see it coming. And that's why, for me, these two things are the most important things when it comes to crypto trading. Right here, I wrote the two most important things you need for your crypto trading journey. One, you have patience. You have to be patient. A lot of people have trading anxiety. The moment they want to place a trade, they become anxious, or the moment they place a trade, and if the price continues to go above their expected buy price, which is their limit price, they become anxious. They get terrified, as in they become victims of FOMO, and they immediately buy a market price or just put it a little below the current price so that they can get in as soon as possible. And immediately they get in, price starts coming down and they begin to feel bad because they'll say, why didn't they wait? So you have to be patient. And part of being patient is being able to identify support and resistance areas, which would I'll show you in this video. Another thing is risk management. The truth is this: without risk management, you won't survive as a crypto trader, no matter how good you are with technical analysis, no matter how good you are with fundamental analysis, no matter how good you are in any kind of analysis. Because, as in, you being good in technical analysis, yes, you make money. That's true. But you would also lose it back to the market. The market will collect it back from you, because you need a system to be able to collect from the market and retain what you collected from the market. And that's where risk management comes into play. Without risk management, without effective risk management, you won't survive. That's the truth. You won't survive for long. I had friends who are good with technical analysis, but they didn't survive crypto trading for long because they were very poor in terms of risk management. Let me give you a hypothetical situation of effective risk management. Take, for instance, you have just $100 to trade crypto. Let's say you're starting very small on a lean budget. The thing is, if your maximum loss, or if the maximum loss you're willing to take in a trade is just $2, you would have to lose about 50 times, or maybe 45 times, including the exchange fees, before you would finally lose your total capital. And 45 times, there is very little possibility of you losing 45 times, no matter how bad of an analyst you are. There is no way you're going to be able to lose effectively 45 times. That's what people don't realize. As in, when you cut your losses, you're giving yourself an opportunity to buy lower. And secondly, you would have liquidity in case another opportunity comes in the market. People don't realize how important risk management is alongside with being patient. So in this particular video, I want to give you an example of how to make an effective risk management plan, and also how to be patient. Okay, let me use this particular coin for example. WAP. Let me give you an example of this. So this dropped well from 0.06679. This was the high, down to 0.05510. So let me use this as an example of how to build the risk management system. Take for instance, I bought at this point. Let's say I bought at this point. I'll show you how. This is a formula to calculate the maximum loss you can take in a trade. I will show you how this formula works. So take for instance, I bought this wax P at say 0.06650. Let me just use that as an example. Let me see, was this up to this? Yeah, kind of. Let's say I bought somewhere, because the high here is 0.06680. So let's say I bought at this point, for instance. Then I bought at 0.06650. Then let's say I want to take a maximum of 2% loss in this trade, and my capital is $100. It means I want to take $2 loss in this trade. That's the maximum I can take. So at what price will I now set it so that it will exit me? That's one of another area a lot of traders have issues with. They know the loss they want to take, but they don't know how much in the value they have to set it, so that when it gets to that point, it automatically exits them. So that's the reason for this particular formula. Stop loss price is equals to buying price bracket 1 minus desired loss actual all over total investment. Then for futures trading, the desired loss actual is equals to desired loss all over leverage. What does this even mean? So if you want to calculate the stop loss price so that you impute it in a platform like Binance, you have to know the buying price, which is this 0.06650. Then 1 minus the desired loss actual. The desired loss, if you're trading spot, and let's say you want to take $2 loss in $100 trade, the desired loss is 2, which is $2. Then all over total investment is $100. So let me show you this particular calculation for a spot trade, and I will also show you this calculation for a futures trade. So the stop loss price for this particular trade, if I bought at this point and I want to take $2 loss in $100 trade, it will be stop loss price is equal to the buying price, which is 0.06650, then bracket 1 minus the desired loss actual, which is $2, divided by total investment, which is $100. See, then we would have to now use our calculator for this, so that it tells us the price we have to set it for a spot trade. So we'll have to 2 divided by 100, it gives us 0.02, which is 1 minus 0.02, which is 0.98. So multiplied by the buying price, the price we bought it at, which is 0.06650. So when price gets to 0.06517, which is exactly $2 loss, we'll set it in our stop loss that at 0.06517 we should be exited from this trade. So we'll set it as our stop loss order. So you could set something like at 0.06518, which would be the trigger price. Then the limit price will now be 0.06517, which is exactly what you're seeing on the screen. This is for a sports trade. So let's look at a futures trade. There's not much difference in this calculation. The only difference is that the desired loss actual, which is this 1 minus desired loss actual over total investment, the desired loss actual would now be the desired loss divided by the leverage. So take for instance your desired loss is $2, for instance. Your desired loss, let's say your desired loss is $2 and your leverage is 5 times. So what you do is now be 2 divided by 5, which is 0.4. So you see, so you would now change this 2 that is supposed to be just 2, you will change it to 0.4. So this is for a futures trade with a 5 times leverage. So what will now happen will now be 0.4 divided by 100. Then 1 minus 0.004. So to give you 0.996 multiplied by the buying price, which is 0.06650. So you see, so the price we would set so that we would take a maximum of $2 loss is 0.06623. 0.06623. So this is the formula you would use to calculate it. As in, if you need this formula, you could comment in the comment section so that I could send it to you so that you'll be able to use it for your trade. So this is exactly how you do it. So take for instance, how do you now use this? Take for instance, you bought at 0.06650 and then it hits your stop loss and you're out of the trade. What do you then do? What you need to do then is to set an order for the next major support area. So if it hits your stop loss, as in take for instance, as we bought at that point at 0.06650, it hit our stop loss and we're out of the trade. So what do we do then is to set our order for the next area of support, the next major area of support. That's what we need to do. So how do we do that? There are indicators you can use. You could do it manually by identifying areas of support and resistance manually, but most of the times you may not be able to identify those areas, especially if you're a beginner. So you could use this support and resistance dynamic by loose algo. Just look for it on TradingView. So you click on this, it will show you areas of strong resistance and areas of strong support. So you could see this is an area. You could change this time frame to 4 hours so that you could see other areas. So you see, so this is on the 4 hours time frame. This is another area. So this is another area of major support. There is also another indicator you can use. It's support resistance dynamic by lump sum. You could click on this and add it to your chart, and then you could do that check hourly. You see, this particular indicator, this support resistance by loan sum got exactly the point, exactly that point. It's kind of scary. It got exactly that point. This guy's indicator is what I use most of the times when I want to set trade by this loan sum, this support resistance dynamic by loan sum. This is the one you can use the most. It kind of gives you the best areas of support and resistance. So it identified the exact point. So these are areas of support and resistance you could see on the chart. So this identify the exact point of support. So what you then do is you will then keep setting your orders based on the next area of support and resistance, and always taking a $2 loss, not more than $2. Take for instance, you're using $100 capital, so that it exits you from the market. If it exits you from the market, look for the next support area again and get in. um you may be able you may It may take like 3 trades, as in, before you finally get in at an ideal spot, but that 3 trade you would lose maximum of $6. And if that trade, take for instance, you lost a maximum of $6, that would be like $94 remaining. Then if, take for instance, you get a 10% move to the upside at the point you bought the last, you would be like maybe around $45 in profit, and remove your $6 you spent. You see that you have over $39 in pure profit. That's how trading works. Trading works by you winning more than you are losing, not by you never losing. As in, any trader who is selling you a strategy where you never lose is lying. So what trading is about is that you're making more, as in you're making more profit than you're losing, such that at the end of the day, you're making profit in total. That's trading. So thanks for joining me in this video. I'll see you in the next one.